Chris Hensley is a registered representative of Cambridge Investment Research, Inc., a broker-dealer member of FINRA SIPC, investment advisor representative of Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Houston First Financial Group are not affiliated.
The Houston Midtown chapter of the Society for Financial Awareness presents Money Matters with your host, Christopher Hensley.
Good morning, everybody. You're listening to Money Matters on KPFT Houston. I'm Chris Hensley. The time is now 10 a.m. I have a great show lined up for you today. It's often said that the chairman of the Fed is the second most powerful person in the world, next only to the President of the United States. Some say the chairman is even more powerful. When Ben Bernanke publicly stated on September 8th of 2013 that the Fed's intent to continue its policy of quantitative easing, global markets instantly reversed direction from a worrying downward spiral to an exuberant upward surge. Even the President of the United States can't do that. Our guest today is Dr. Robert R. Johnson. Now, Dr. Johnson is the CEO and president of the American College of Financial Services. He is also the co-author of a brand new book that just came out called Invest with the Fed. So we're really going to do a deep dive into this topic, so please stay tuned. He'll be joining us very, very shortly. We always use the first few minutes of this show to tell you a little bit more about who we are, the Houston Midtown chapter of the Society for Financial Awareness, or SOFA. SOFA is a nonprofit 501c3 educational speakers bureau, and our mission is to fight financial illiteracy. We do that by going out to different companies, different organizations, different groups, different professional associations, anywhere people already congregate, and we provide financial education seminars as well as health and wellness workshops. So what does this look like? Well, for instance, next week I will be going out to a company called Lopez Negrete, and I will be doing a seminar called Refinance Your Mortgage 101. Typically, when SOFA comes out, we're doing financial education workshops, and companies will often have their 401k guy, their 403b guy come out and talk. And when they talk, it's usually focused maybe around retirement, maybe a little bit of asset allocation, but most of the time it's an enrollment meeting where they're just really getting familiar with the website. They're getting familiar with how to check their balances on their 401k accounts, but you don't see a real deep dive into the educational aspect. And that's what SOFA is really, really good at. There is something called 404C, and 404C is an ERISA requirement that basically states any company that has a ERISA-sponsored retirement plan has to have a financial education piece in place. And so a lot of times we'll see these companies offload this to the 401k guy, the 403b guy, but you don't see that deep dive into all of the different aspects of financial education. So we're talking budgeting, making some of the most difficult financial decisions that you'll make over your lifetime, purchasing a home, negotiating a car, saving for college education. We have volunteers that go out and talk about wills and estate planning. Purchasing a home would be a realtor. Health and wellness, that could be a healthcare professional or a doctor. So all of these are done pro bono at no cost to the company by experts in their field, professionals in their field on a volunteer basis. So how does this work? Well, if we are asked to come out to an organization, then usually this is going to be a brown bag lunch and learn type seminar, maybe during the lunch hour. We've been known to go out around the clock, depending on the need of the organization. I know that we've had city governments that have had 911 responders, firemen, policemen that can only get off of the clock one time a year, and so they'll piggyback us onto a safety meeting. I've gone out to companies that have people that work around the clock, so we've gone out in the middle of the night to a factory floor picture me with a hard hat on and doing financial seminars. That is the case. We do work around whatever the need of the company is. To find out more about SOFA, you can visit our website at www.houstonmidtownsofa.org. If you're listening outside of the Houston or Gulf Coast Houston Metropolitan Gulf Coast area, you can also reach out to our national organization, which is www.sofausa.org, and they can find a SOFA member in your city and state if you are in the United States. And with that, let's go ahead and get our guest on the line right now. Dr. Johnson, are you there?
I am.
Excellent. Well, thank you so much for joining us today.
I appreciate it.
Well, I usually start the same way. I'll read a little bit about your bio and introduce the listeners to you. Dr. Johnson is a PhD, a CFA. He is the president and CEO of the American College of Financial Services, which, as a financial advisor in my industry, this is one of the most known schools out there for credentials when it comes to financial planners, when it comes to financial advisors. Very well-known school. He is also the co-author of a brand new book that just came out called Invest with the Fed. So once again, Dr. Johnson, thank you for joining us.
It's a pleasure to be here, Chris. Thank you for asking.
Absolutely. And if you could, I'd like to take the first question here just to share a little bit more about you outside of the bio so that we can get to know you a little bit better.
Well, I had a very auspicious start to my career in the financial services business. I grew up in Omaha, Nebraska, and I was a classmate of Peter Buffett, Warren's son. So the first person that I was ever introduced to in the financial services arena was none other than Warren Buffett.
Wow, that would be a jump start for me as well. One of my personal heroes here. So,
and the first share of stock I ever bought was Berkshire Hathaway. And it was not that I was that smart. It was an accident of birth, if you will. So it's worked out.
Absolutely. Well, that is very. Not everybody can say that they got to meet Warren Buffett right off the bat. So that is awesome. Well, let's really start from the beginning, because a lot of my listeners, I would say, when we talk about the Fed and we talk about interest rates, we can get very, very complex here. But I like to start from the very beginning. Can you explain what Fed rates are to the layperson who really has no idea?
Sure, and it's a difficult concept for many people who don't have a financial background to grasp. But when we talk about Fed rates, really what everybody's referring to now in the markets is the Fed funds target rate. And the Fed funds rate is the rate on loans that banks make to each other. Banks need to keep a certain amount in reserves, and sometimes they need to borrow from each other. Fed funds loans are really very, very short-term in nature, and sometimes they're called overnight money. The Fed has a target Fed funds rate, but it doesn't set the actual level of the Fed funds rate in the market. That's determined in a market environment. But the Fed, again, does set a target or desired level for that rate, and that's the rate everybody's focused on. Currently, the Fed funds target rate is 0.25%, or in the investment parlance, that's 25 basis points. That's as low as it's ever been in history. The target Fed funds rate, just to give you some historical perspective, was in excess of 19% in the early 1980s when the Fed was fighting inflation. And by the way, when I was trying to find my first job in the financial services area, and I can tell you how disastrous that economy was. As recently as 2001, it was over 6%, and right before the financial crisis, it was over 5%. So right now, that rate is as low as it has ever been.
Wow. Now, I know you said quite a bit there, and I'm going to just kind of break it down here. We talked about the target rate, the Fed funds target rate, the rate that banks loan money to each other. We talked about overnight money, and that the actual rate right now is 25 bips or 25 basis points, 0.25 actually, and it's been that way for a while. From a consumer standpoint, why might I be concerned if rates rise or they lower? Why should I care?
Most consumers aren't going to be concerned with what the Fed funds rate is because they're not borrowing using the Fed funds rate. But everyday consumers are affected because the Federal Reserve interest rate policy influences borrowing costs throughout the entire economy. That is mortgage rates, automobile financing rates, home equity rates, to name a few. You know, when you see that Fed funds target rate rise, you'll start to see other interest rates rise throughout the economy. And basically what the Fed does with the Fed funds rates reverberates throughout both the financial markets and the economy.
So you can see it not just the financial markets, but when you go in to, say, buy a loaf of bread, or if you pull up in front of the gas station there and start pumping gas and you look at the prices of gas, that's all somehow accounted for in the market.
No, exactly, yeah, but you're really going to see it through the transmission of interest rates throughout the economy. If you're going to buy a home, or if you're going to buy a car, or if you're going to get a home equity loan, as the Fed starts to raise rates, you're going to see the rates on those instruments rise.
So as a consumer, if I'm in the market for purchasing a home or purchasing a car, really we're going to see, as rates rise, we can see some of this influence in the interest rates on these loans.
Yeah, and I think what we're seeing, Chris, is that most people, it's not a matter of if interest rates are going to rise, but it's a matter of when interest rates are going to rise.
Right.
So if people are delaying, for instance, buying a home, thinking that rates may fall further, there's a lot higher probability that rates are going to rise in the near term than they're going to fall in the near term. And again, they're at historical lows now. If I was in the market to buy a new home, for instance, or to refinance an existing home, I'd go ahead and do it.
Absolutely. And I put a big asterisk there when you said historical lows, because that's really where we're at. They have never been this low. Now, when it comes to the Fed uses they raise and lower rates in order to change what's going on in the market or into the economy, or to really adapt to it. What other options does the Fed have other than raising rates, and what other tools are in their toolbox?
Well, the Fed can raise reserve requirements at banks, requiring banks to keep a higher proportion of their assets in reserves. That's going to decrease the amount of lending activity, which is going to decrease the money supply. But what the Fed really does is the Fed does open market operations, and basically they buy and sell government-backed securities. And if the Fed wants to lower interest rates, it buys a lot of securities. That is, it puts more cash into the banking system. And with more money available out there, interest rates are going to fall. If the Fed wants to raise rates, it sells these government-backed instruments. And selling decreases the amount of cash in the banking system. And that's actually how the Fed affects interest rates. The target rate, this target Fed funds rate that everybody's focused on now, is a signal about what the Fed is going to do in open market operations. So the Fed signals that, for instance, it's going to start, in effect, doing more open market operations to raise interest rates by saying the target Fed funds rate will increase.
Now, this signal, sometimes they'll tell us they're going to do something and they don't, and then so sometimes they'll get us all ready and they don't. Let's talk about if rates are if low rates are good, why not keep them low forever?
Yeah, in fact, I've answered this question a few times. The problem is that lower interest rates can also lead to inflation. The Fed really is balancing the positive effects of lower interest rates, that is economic growth, versus the deleterious effects of lower interest rates, and that is potential inflation. And, just like the fairy tale of Goldilocks and the Three Bears, the Fed wants the proper balance between economic growth and inflation. The Fed tries to get that balance just right, and that's the key, the key to Fed policy. And it's done, it's not a one-to-one relationship. The Fed is picking up signals from the marketplace, then changing policy. That policy then has to work its way through the economy, and sometimes, quite frankly, they get it wrong.
Absolutely, and so the idea of keeping rates low forever, it's one of the ways that inflation is really one of the things that would come up. Can you tell us a little bit more about inflation for somebody who doesn't know what inflation is?
Yeah, well, inflation is just when costs of goods are rising. As the price of a good increases, demand's going to go down. Then less demand is going to lead to less production, and eventually we're going to have unemployment. And that's the problem with inflation. And inflation doesn't affect everybody equally. There are some people who, for instance, if you're a net borrower, if you have a fixed mortgage rate, for instance, inflation doesn't hurt you because you're paying, the current money being offered is being offered at a higher rate than what you borrowed at. So there are different effects to inflation for different consumers.
Very good point. Inflation, you kind of have to point to something and attach it to it to say how an inflation is going to affect you, or if it even affects you at all. Now, let's talk about, because we just got finished with September here. We expected rates to go up, and they did not go up. But when do you expect the Federal Reserve to raise interest rates?
Well, it's funny, Chris. Many people, including me, were anticipating that the Fed would raise the target Fed funds rate last month, but it didn't happen. And it didn't happen because the Fed was worried that such an increase might stall any economic recovery. In other words, the Fed wants to make sure that the economic recovery is strong enough before raising rates. Now, I think the Fed was right, by the way, in retrospect. The weak jobs report last Friday indicated that fewer jobs were created in the economy than expected. And, this is troubling in that it appears that the economic recovery is indeed weaker than what we're hoping for.
Very good point, because I'm one of the ones we've been hearing about this for a year, and I didn't say I was hoping, but I was like, I feel like they were kicking the can down the road some more. But just as you said, in retrospect now, with weak job reports and stuff, it may have just been the right decision.
And by the way, you don't have to just settle for my opinion. We can look to the interest rate futures markets and see what the consensus of the market feels is the probability of a rate hike. And I looked at that this morning. Bets on interest rate futures show that investors only see about a 30% of a chance of a rate hike this December, and that's down from 50% before the release of the jobs report. Actually, what the interest rate futures markets indicate is that investors are betting on a rate increase next March.
Wow. So that's different than what we initially thought right at the end of September. I think everybody was kind of thinking, well, if they didn't do it now, they're going to do it in December. So very interesting. Well, that leads me to my next question. How do you expect the market to react once rates are raised?
I think it's curious. I think that in the very short run, the market's going to react positively to a rate hike because it's going to end the uncertainty about when that hike will occur. There are a lot of sayings in the market that are considered, quote, conventional wisdom. Some aren't conventional and some aren't wisdom, but one of the truisms in the market is that the market dislikes uncertainty. People know that rates are going to increase. And again, it isn't a matter of if, it's a matter of when. I actually think that by reducing the uncertainty in the short run, that's going to be received very positively in the markets. But the long run's a different case. In the long run, the research that Jerry Jensen of Creighton University, Luis Garcia-Fiehue of Florida Atlantic University and I found in our book, Invest with the Fed, is that the stock market performs dramatically better when rates are falling than when rates are rising. In fact, we found that the direction of interest rates matters much more than the level of interest rates. And just to give your listeners some color on this, from 1966 through 2013, so a 48-year time period, the S&P 500 returned approximately 15.2% on an annualized basis when rates were falling. When rates were rising, the S&P 500 returned only about 5.9%. And that's really a dramatic difference. And it wasn't the level of interest rates, again. It was the direction of interest rates.
Interesting. Very interesting. Now, that your book, in fact, Invest with the Fed, it really sets up a system or a way to manage investments based on some of this. Now, as a financial advisor myself, I have to be careful and put an asterisk next to anything we talk about. This is not a blanket statement to tell people to go invest in certain ways, but we can talk very generally about this. How would a rate hike affect different asset classes?
Well, as I just noted, stocks perform much better in a falling rate environment than a rising rate environment. What we found, interestingly enough, was the returns to government bonds aren't much different in different interest rate environments. Now, the return to high-grade corporate bonds are better in falling rate environments than in rising rate environments. If you go further out on the credit spectrum, the returns to junk bonds or high-yield bonds are much better in falling rate environments than in rising rate environments. And that makes sense because junk bonds are kind of a hybrid between equity and debt. Real estate, interestingly enough, does much better in falling rate environments than rising rate environments. Yet real estate investment trusts kind of hold their own when rates are rising. In fact, real estate investment trusts, equity real estate investment trusts, earned about 10% compounded annually when rates were rising, which is much better than the S&P.
Absolutely, and real estate would fall in possibly its own either alternatives or its own asset class, and so that's something because usually people will seek these alternatives if the market's down, and it's interesting that some of these things, adding the rising rates and the lowering rates to how it actually affects them, is a very, very interesting way to look at it. If we drill down a little bit further into sectors, what sectors would benefit the most from rising interest rates?
Well, not stock market sectors, but I want to get back to your point on alternatives, because commodities are one asset class that does much better when rates are rising. We found that a broad commodity index returned 17.6% when rates were rising and actually lost 0.2% when rates were falling. And that gets back to the inflation element, is that a lot of times commodities are tied to inflation. On the other hand, gold didn't do very well across all interest rate environments, and I find that really curious because gold is often touted as a safe haven.
Right.
Gold provided fairly pedestrian returns across all interest rate environments, and in fact, Chris, during rising rate environments, the return to gold was less than the inflation rate. So people didn't even maintain their purchasing power by buying gold in rising rate environments.
Wow. So then that's interesting. As an advisor, I'll sit in front of people and we'll have this conversation, and then about 15 minutes into it, they're like, well, I have this gold, or I saw this on or somebody told me this or that, and they'll always kind of pull that out of their back pocket, and so that's interesting because gold falls into that metals, that commodities, what we've heard a lot of as advisors in the last 5 years, alternatives. And if you look at how some of these things are performing when rates are going up, it's contrary to what we're thinking. So that's very, very important to note. What are some of the negative aspects of rising rates?
Well, obviously borrowing is more expensive to both consumers and businesses, and obviously economic activity tends to slow when interest rates are rising. I'd temper that comment a little bit now in the current environment because we are at such historically low levels that, I think a lot of those negative aspects of rising interest rates aren't going to be seen until rates more normalize, if you will. It was funny, I was asked the other day, do you think that we'll ever see rates again in the 5 and 6% range? And I had to laugh at that because, I was, like I said earlier, I was in the job market in 1981, and Treasury bills were yielding near 15%. Wow. I think what people do is they look at the last period and they succumb to recency bias. That is, they think that the last few months or the last few years are going to continue on into the future. And I really do see that in today's environment, that people can't even imagine that we're going to return to kind of more normal rates. And quite frankly, I think we will in the not too distant future.
Yeah, a lot of this is cycles, and so we know that it'll go through and that things cycle through. But when you mention recency bias, that is extremely important. We're looking at it when we talk about interest rates, but just in general, when it comes to financial behaviorism, we can see that across the board in many different things. I see it in generational different planning clients that I have coming in. I have young people that all they've seen is from 2008 and forward, and so they are less optimistic about the market. But then I have people that have are near retirement, or what you call the baby boomer band, and they've seen the ups and downs. They've seen the internet boom back in the 90s, and so they're maybe more optimistic. But the recency bias thing is very, very important. We're actually bumping towards the end of the show here. Before the end of the show, what have I forgotten to ask you that you want to tell us about this topic?
Well, attempting to time the market is extremely difficult. So that's the first thing I would say, is that I don't believe that your listeners should attempt to time the market. But I do think some sector rotation, that is, moving some money from sectors that perform well in falling rate environments to sectors that perform well in rising rate environments, is a good plan. And let me just give you a few. Energy, consumer goods, utilities, and food are the best performing sectors during rising rate environments. And Chris, it makes sense because people need to put gas in their cars, they need to brush their teeth, they need to heat their homes, and they need to eat whether rates are rising or falling. It doesn't mean that these sectors, by the way, performed better during rising rate environments than falling rate environments, but they held their own during rising rate environments. And the thing that the last thing that I would leave your listeners with is that you should revise your equity return expectations downward as interest rates begin to trend upward.
That's good advice. That is good advice, especially you mentioned earlier some of the different bond classes that I think a lot of people think that's a safe money area, and when rates go up, we've seen negative returns in some bond funds, some different parts of bond funds. So if that's something that people aren't used to, it is a possibility. It's something that very, very wise words there. Dr. Johnson, thank you so much for visiting with us today. For listeners who'd like to find out more about Dr. Johnson, you can visit the American College website, and I will also have a link to the book on the podcast version of the show as well. Dr. Johnson, do you have any parting thoughts you might want to leave the listeners with today?
Well, I believe that one of the things that really is a truism in the market is that it's time in the market and not timing the market that leads to wealth creation. The best time to start investing is today.
Absolutely. Thank you so much, and have a great weekend.
Thank you.
And you have been listening to KPFT Houston.
Thanks for listening to today's episode of Money Matters Podcast. If you enjoyed the show, visit us on the web at www.moneymatterspodcast.com. drop us a line on SpeakPipe on the right-hand corner. It will receive any voicemails, questions, thoughts, concerns that you have about the show. In addition to this, we recently launched a Patreon campaign. Click on the Donate Now tab to hit the tip jar and find out what Patreon's campaign is all about.